All right, welcome everyone. Today's webinar is Investors Insights, Current Market Update and 50 Years of Investing Lessons. So we're in November, and this is our last webinar for the year. And then as we go into January, we'll be doing our annual economic and market update that I'll remind at the end. But just given a lot of the uncertainty in the economy, as well as a lot of the volatility we've had at the markets over the last 3 or 4 months, I wanted to just provide an update and provide some perspective. And so our whole focus today is just around what's going on in the markets at a very high level. And hopefully we can potentially do some Q&A as we go through the material. So as you all know, when we're going through some of this data, it can be, there's a lot of data. I like to go through data, but hopefully you find it to be valuable. And then again, just from a housekeeping perspective, use the Q&A tool and just go ahead and submit the questions throughout the webinar, and I'll either save them for the end or I'll be taking a look as we go through. And so again, welcome. My name is John Vance. I'm the president of Vance Wealth, and hope you enjoy our talk today. All right, just some quick disclosures that I will not be reading to you, but you can take a quick snapshot if you would like to read through all that data. All right, so just as we go through and talk about the market, so we're gonna talk a little bit about the equity market, stock market, and then talk about bonds, and then we'll get into some historical perspective. So this is just an update year to date through last Friday, and you can see we've highlighted a bunch of data here. So you can see we have on the left-hand side the different equity markets between the S&P 500, Russell 2000, which is the small cap index, and it just makes its way down the list. You can see all the different indexes. I highlighted in green a year-to-date basically chart the year-to-date section, which shows what the S&P 500 has done for the year, which is also known as large cap or large company stocks. The Dow Jones 30, which tends to represent more value type companies, more blue chip, and then the Russell 2000, which is small. So you can see just even this year, we've seen a divergence between small and larger caps companies. And then you see on the very far right, on a 3-year basis, how there's pretty different performance between all these indexes if you look at the entire list. So a positive year, but not a great year. We did peak back in early July, and markets are trying to make their way back. So we had a fairly strong October. As you know, we're very long-term investors. And so while we do believe it's really important to understand what's happening in the short term, we try to, I guess, sift through the noise, and we do pay attention to this, but we also know that markets are going to be volatile. They've been volatile forever, and that's going to continue. So as we then dive deeper into how the market has performed, if we look at some of the areas around inside of the market, right? So when we look at the S&P, that's just the broad market. But when we actually dig a little bit deeper, on the very far left-hand side, you can see the communication services sector has been the strongest performer, up about 43%. And I believe that's led by Facebook. And then you can see technology is next. And then you can see then on the far right-hand side, healthcare and utilities have been the lagging sectors in the economy so far. So from the best performer up 43 to the worst performer down 10, that's a pretty I guess it's very contrasting numbers when we look at what's just happened over the last 11 months. The chart on the right, I know it has some initials on there, VBG at the top, that's value, blend, and growth. And then LMS stands for large, mid, and small. So this is just trying to represent part of the stock market and different categories. And so you can see if we look at in the far right, I've circled it in red, large cap growth is up about 28%, where small cap value is essentially flat or down slightly through the November 3rd. If we contrast this to last year, so just keep these data points in mind. When we look at this last year, I did flip this around a little bit, but if you look at the very far right-hand side, communication services was the worst performer, down almost 40%. And then coming back to the initial slide, it's up 43. So the worst performer last year is this year's best performer. The second best performer this year was last year's, I guess, third worst performer. So you tend to see that happening in the markets where leadership shifts. And looking at last year, large growth was the worst place to be, down 29% for the year, large value, more blue chips type investments were down 7%. But as we remember, 2022 was a pretty ugly year. 2023 has definitely been more positive. But because of the volatility recently, it doesn't feel positive. And on top of that, there's a lot of economic, let's call it bad news. And there's also a lot of geopolitical issues happening around the world. I know that puts that mildly, but those are all certainly headwinds and things that are causing investors to be concerned. This chart is a bit noisy. And when we look at it, what this is basically showing, I'm just going to move something here. What this is basically showing, on the left-hand side, it shows large growth, large value, mid-cap core. So it shows all these different sectors in the market. And my headline on here is why diversification is so important. And so the reality is when we invest our clients' money, we're investing in all these different areas, right? From growth to value, large, mid, and small. And what this is basically showing us is that compared to the S&P 500, basically large growth has been the only category over the last 10 years that has outperformed the S&P 500. So large growth has outperformed by about 13%. And then you can see all the different categories over the last 10 years have underperformed. Now, well, that's the reality that we've just lived through. If we look historically, that tends not to be the case, but it is the case now. And as investors, we're always looking ahead for what are the opportunities so that we're positioning portfolios in the right way on a go-forward basis. So when we look at some of the historical, why did this stop working? Give me one second. Oh, here we go. So when we look at some of the long-term data, so this is a long-term chart going back to 1970. So on the left-hand side, you can see this is looking at growth versus value from 1970 to 2022. I am going to zoom in so that you can see a little bit more closely the different rates of return. So over the last 50 plus years, going back to 1970, small value has averaged about 13.5% a year. And then you can see large growth has averaged 8.4% per year. So when we look historically, small and value tend to outperform, but we've been living through a period of time where that has not been the case. And so let me go back a couple charts just to remind you of what we just looked at. So you can see here, the lowest performer over the last 10 years has been small value. That shows on the bottom of this chart on the right-hand side relative to the S&P. And so we know that markets are gonna yin and yang. We're gonna have parts of the economy, parts of the markets that are gonna be stronger than others. But we are confident that over time that these trends tend to fall back into place, and which is why we manage the portfolios in the way that we do. And so you can see here, this does give us that justification of why we believe small value and over time will generate stronger returns for portfolios. If we then look at a shorter period of time, because 50 years is a long period of time, and we just look at the last 20 years, so this goes back to 2003, and we're looking at some different data points. Where you can see here is the compounded annual returns for small stocks. So over this last 20-year period, smaller stocks have averaged about 10.4%. Large stocks have averaged about 9.8%. So over the last 20 years, the advantage for small stocks is still there, but it's not as large as it historically has been. If I pulled up a chart going back over the last 100 years, we'd be looking at small caps have an advantage of closer to 2% per year. And over this period of time, it's been more narrow. Now, and that's what we just referred to. And the other thing is when we look at the very bottom, because I think this is a headline we're seeing a lot of right now, is inflation, and then also T-bills, right? T-bills is another way of thinking about cash, money market accounts. The last 20 years, inflation's run about 2.5%. The last several years, inflation's been over 5%. And then T-bills, which have been pretty much, below the rate of inflation. So what that means is that if you had your money in cash or had your money in T-bills, after inflation, you actually lost money, right? So that's why we look at T-bills as a very good parking place, but not as a good long-term investment vehicle, because of the fact that for most times in our history, the T-bills are actually yielding or paying some sort of a negative rate when you adjust it for inflation. So this has been the investment environment that we've been in for the last 20 years. But the environment we're in now has changed, right? Because the reality is T-bills are now north of 5%, and inflation is elevated and starting to come down, which is what the Federal Reserve's objectives were. So when we look at the journey that we have been on over the last 20 plus years, so this chart is about 25 years, right? It goes back to 1999, and it shows what the Federal Reserve, the Fed funds rate was over this period of time. So if you start on the very far left, you can see the percentage. The very top of the chart, it shows 8%. At the bottom of the chart, it shows 0. And then as we move from left to right, it shows the year, so 1999, all the way up to current. And even beyond current, there are some projections for expectations for 2025, as well as the long run. And if you look at this, we've gone through this really up and down environment, and some of these data points are going to be relevant. So we had interest rates rising as we left the decade of the 90s. That was followed by the dot-com bubble and the market crashing. And when the market crashed, guess what happened? Interest rates came back down. And then we saw the economy strengthen post-2003. Rates started to rise back up. We went into the financial crisis. And then you can see there in the middle from 2008 to 2015, we basically had a zero interest rate policy. So interest rates were essentially at zero for a long period of time. And that really helped the stock market, it helped the bond market, at least on the declining part, and then it helped the real estate market. Then we started to actually raise rates from 15 to roughly 19. And then when COVID hit, we started cutting rates again. And now we've been on this mad dash to 5.5%. So rates have risen sharply. We really haven't seen rates rise to this degree in over 50 years. And it's a pretty sharp move, and it's causing some cracks in the economy. Some cracks that we don't fully know yet, but we're starting to see that in the banking system and the real estate area. And we think that will play out over the next 6 to 12 months. That will have a little bit more visibility on what all this means. Well, the reality is, if you've been watching, reading the financial headlines, either watching it through news, reading the paper, reading articles, it seems to us like the Federal Reserve is going to pause at this point. And likely we're seeing peak rates at this time. And so if you notice in this chart, it does show that the forecast is that expectations that rates will start coming down. Not extremely quickly. We're looking at some maybe modest rate increases from the rate decreases from 5.5 down to maybe 4.5. The long-term target, though, for the Fed is to have interest rates around 2.5. So we're well above that number now, and it'll be interesting to see how we come back to some normalcy. And frankly, I mean, had we, I do a lot of economic and market updates. When we look back 2 years ago, we did think that rates were going to rise. We certainly didn't think they were going to rise this sharply and even this high. We thought we would see rates potentially push into the 3% range, and that's overshot to the upside. Now, the good news is that's offering some attractive interest rates for people who are investing in T-bills and bonds and cash. They're finally starting to pay money. So there is a silver lining in that some of the cash investments, as well as some of the safer investments, are finally generating some return. And many of you know, I started back in this business back in 1997. And at that time, you could buy a 10-year government bond that was paying 7%. So the reality is we've seen interest rates collapse and then rise back up to these levels. And again, these are levels we haven't seen since 2007. So it's been 15 years since we've seen rates in these areas. And many of you as clients, we've been having the conversation with, let's get some of the money from the banks and put it in money market accounts, getting some higher interest rates, as well as looking at, does it make sense to diversify into some of these safer investments, given some of the expected returns for stocks and for real estate? Should we be allocating more money to bonds given that they're generating a higher return? And that's a really important question, and I think that is a individual question that we're having with all of our clients right now, because it's an important question to have. When we start digging into the bond market, and again, I know I warned you ahead of time, there's a lot of data here, but one of the things that has been really attractive in conversations we've been having is, you can see what I circled on the right-hand side is U.S. Treasuries, right? So I circled there the U.S. 6-month Treasury. So I believe this was as of this morning, the 6-month Treasury was paying 5.5%. So there's something in the economic circle called the yield curve, and the yield curve represents what are the yields paying from basically a 1-month maturity all the way up to 30 years. And so as you work down this list, you can see it says 1 month, 2 month, 3 month, 4 month, and then it goes 1, 2, 3 years, right, all the way to 30 year. So right now the 6-month is paying the highest level, and that's abnormal. Right now, we have what's called an inverted yield curve, which means that short-term rates like 6-month T-bill are paying more than a longer-term rate. So that's inverted. typically what happens is shorter term rates are lower and longer term rates are higher. And the reason for that is that if anyone's going to incentivize you to lock up your money for a period of time, the longer you're going to lock it up, 5 years, 10 years, 15 years, you're actually going to be, you're going to demand to be paid more, a higher rate if you're going to lock up your money. And so we're definitely in an environment that is unique. We have had inverted yield curves in the past. I think in the last 30 years, this has happened 6 or 7 times. So it's infrequent, but it does happen. It's infrequent, but it's a common occurrence when you look at it over a larger cycle. Whoops. And if you look on the left-hand side, you can see what's happened in the bond market. So I am showing you that right now, money market rates are north of 5%. Banks still aren't paying a lot. You know, if you're with the big bank, they're kind of begrudgingly paying more, but they're not doing it very quickly. We're still seeing a lot of bank savings rates that are, you know, below 1%. Credit unions are getting a little better. We're seeing stuff, you know, north of 2%. But really traditional money market rates and the T-bills, you can get rates above 5%. And so, but on the left-hand side, what we're looking at is what's happening in the bond market, because it's been a strange year where rates have continued to go higher. And so you can see there on this chart, the broad market for what they call the US aggregate. So that's just the overall bond market index. And the overall bond market index is looking at all different types of maturities. It's looking at treasuries, corporates, all kinds of different bonds. It's actually slightly negative for the year. It's down 0.5%. And it's mainly because interest rates have continued to go up. So we're now sitting in a position on a go-forward basis. You can see the latest yield on the US aggregate is 5.4%. That is the highest that we've seen in over 15 years. So that is the silver lining, is that on a go-forward basis, we're getting some higher returns out of the bond market. So as we pivot, so the data that I just shared with you is providing some context of what's happening in the current markets. And I had mentioned earlier that we're going to do a much deeper dive in January of assessing what's happening in more areas of the market as we recap the year of how things played out. A big part of investing is having discipline. And we know, especially right now, I mean, if you turn on the news or pick up the local paper or a national paper, there's just a ton of really terrible headlines. And those headlines drive emotions. And when we're emotional about whatever it is, especially when we're thinking about our money and making good decisions, the geopolitical risks, the economic issues, the political side of things that we're seeing out of Washington coming into an election year, you know, emotions run high. And the emotions we're seeing, I mean, this is like the chart of emotions, right? You have a bit of optimism, right? And then the markets tend to go up when you're optimistic, and then you have elation, which means things tend to be overvalued. Markets come back down, people are feeling nervous, then the markets bottom out, and that's known as fear, and then they go from fear to optimism, right? So markets just tend to go through this cycle over a long period of time, right? And when you go from optimism to excessive optimism, which is really elation, I would say right now we have a fair amount of nervousness and a lot of fear. So those are the emotions that we're feeling. And I think it's really important that we don't want to allow those to drive our long-term decisions. Because, you know, I looked through the list of people on this webinar today. I mean, we have people in their 30s and 40s, and we have those in their 70s and 80s. And, you know, even those that are in retirement that you know, they'll tell me, oh, I'm, you know, I don't have that much longer to live, or I'm old, I shouldn't be allocated. You know, I don't have a long time horizon. Maybe that's what they say. They say, I don't really have a long time horizon. But I would argue that even in your 70s, you live till your 90s, you might have a 20-year time horizon. So it's really important to maintain that discipline and not allow a lot of the headlines to drive concerns and really disrupt your overall long-term investment decisions. And we all know that, you know, unfortunately, most investors aren't really wired for humans, I should say, are not really wired to be good investors, because there's just a lot of things that create self-doubt. And, you know, when we look at being a long-term successful investor, you know, a buy and hold strategy tends to be the best. I would tell you, not a buy, hold, and bury your head in the sand. It is important to be monitoring your allocation. That's what you've hired us to do. It's also important to be rebalancing your allocation because markets are moving. So we want to keep your accounts in line with your overall financial goals as well as your risk tolerance. But as you look at some of these these notes on the side is like, we have a tendency to potentially make some mental errors because we either think we can outsmart the markets, or we think we have we can pull out our crystal ball and tell the future. But the reality is, nobody knows what's going to happen tomorrow, and that's why diversification is so important. So part of this exercise in transition, starting from what's going on today and what's happening in the markets, transitioning then from, okay, well, let's look at some historical perspective, because I do think when we're in the middle of these heightened tensions, it always feels like we've never been here before, and how are we going to get out of this? And it's not going to change. And the reality is, we've been through many different types of economic challenges, and we've found a way to make our way through that. And I do have a slide that says past performance is not indicative of future results, and so we don't know what the future is going to hold. But we do have confidence and faith in the process of being a long-term investor. So what I'm going to do is give a little bit of history lesson. I'll be walking through this. You haven't seen this presentation. This is a new twist on some things we've talked about in the past. So I hope you find this to be insightful. So when we look back over the last 50 years, right? So let me just go back a slide. 50 years and 3 bear markets. So over the last 50 years, we've gone through 3 bear markets. And I'm defining a bear market in this context as down 50%. So massive bad market. Now, a traditional definition of a bear market is a 20% loss. I would argue that 20% losses can happen pretty frequently in the markets, but we're looking at, I don't want to say, I guess it's a major bear market, and we're looking at losses of over 50%. So over the last 50 years, we've had lots of different drivers of success for the economy. And if you look through these headlines, you can see it's pretty remarkable when you look at what was dominating the 1970s. It was really the oil market and the metals market. Gold was skyrocketing and oil prices were skyrocketing. Through the 70s and 80s, we had the rise of home computing and personal electronics, right? That was a massive push. And then in the 90s, a new generation of mobile communications, right? Dealing with telecoms and media and some of the technology we're seeing today. Then the 2000s, emerging markets and the rapid urbanization of China, mining and consumer products took off. Then we had 2010, we had IT, e-commerce, and internet platforms really take off. And then 2020s, we're seeing this in healthcare innovation, a lot of the transition in energy, electric vehicles. And so you're seeing that over this long period of time, there's been different types of innovation. But that's the beauty of our economy and our entrepreneurial spirit, is that we continue to invest. We continue to reinvent ourselves. And that's what makes investing such a dynamic process and actually an exciting one, especially when you take a long-term view. When you take a short-term view, it can be a little bit scary. We recognize that. So we're going to do a little history lesson. So when we look at 50 years, basically, if you were born before January, I guess we can update this. If you were born before November 8th, 1973, you've already lived through 3 episodes in which the broad US stock market went down by roughly a half, so 50%. So these were the periods of time, and I know it was not exactly, but these are these great bear markets when they occurred. 1973, we had down 48%. 2000, which was the dot-com bubble burst, was down 49%. And then October of 2007, down 57%. These declines were driven by real crisis. There were things happening in our economy that there was a reason for this. This wasn't your run-of-the-mill bear market, your run-of-the-mill correction. There were some real crises that were happening in the markets. So in the 73 correction, we're looking at an oil embargo, and we had inflation was exploding during that time. We had multiple recessions. We had multiple recessions in the 70s, but this was a recession during this period of time. Unemployment peaked at 9%, and we had Watergate. As we looked at the next period of time, March of 2000, we had the implosion of the dot-com bubble. The NASDAQ was down 80%. Think of that, 80% from March of 2000 to October of 2002. We had a recessionary environment. We had Enron and a bunch of accounting scandals that were happening. And then that was also a time where September 11th was right in the middle of that. So markets lost 49% over that period of time. Then we went through the subprime mortgage catastrophe, the global financial crisis, and we had the longest and deepest recession since the 1930s. This was also known as the Great Recession, and unemployment peaked at 10%, right? So these were three very painful periods over the last 50 years. Now, this chart goes back longer than 50 years. This is about a 70-year chart. What this chart represents, the blue represents a bull market, which means a rising market, and the purple represents a bear market, which is a declining market. So when you look over the period of time, the recoveries last a lot longer than the downturns. And you can see, you know, if you look here, it's starting at that 1973 period, you can see the bear markets that we've had. So while we're illustrating three bear markets over that period of time, you know, there has been actually 7 bear markets, but only 3 of the magnitude of down 50%. And in each subsequent one, we had a massive recovery. And that has been the norm for our economy. And we believe that that's going to be the norm on a go-forward basis. But, you know, all of these things will look differently on a go-forward basis. But this just is designed to represent that this idea of, you know, over time, this will pass, and this will make our way through the challenges that we have today. So a couple things to just cement home around the stock market, because I think a lot of times people think about the stock market and, you know, they feel like, you know, it's very volatile. I don't really have, you know, while I know I'm buying companies, you know, the whole idea of it is not a tangible asset, right? If I buy my house, it's a tangible asset. If I run my business, it's a tangible asset. I know what I have. When you're buying the stock market, you're putting your money into investments that you have really no control of. So at the end of the day, what drives the performance, or what drives the rising of the stock market or the declining of the stock market? And the reality is, over time, the markets will go up because profits of the companies that are in the market go higher. And so what this is designed to show you here is the index, which is the S&P 500 index, has gone up 32 times over the last 50 years, and earnings of these companies have gone up 35 times. So there's a very direct long-term correlation of as earnings grow and profitability grows, that will drive the index higher. And I believe it was Benjamin Graham, but I might have the wrong person, who is really the professor, the teacher of Warren Buffett. This could have been a Warren Buffett quote, but he talks about that in the short term, the stock market is a voting machine, and in the long term, it's a weighing machine. And when you think about a weighing machine, you're weighing profits. So over the long term, the profits are what matter. In the short term, these economic headlines are going to drive things, and they're very unpredictable. And that's why a lot of times we don't use those to drive too many decisions, because we know over time the weighing machines, the profit of the companies over a long period of time will provide those benefits. So then we look at is, okay, well, why has why have earnings gone up so much? You know, why has that actually occurred? And a big driver, if you look on the left-hand side, it shows productivity growth. You know, real GDP, so gross domestic product per capita per person, has gone from 26,000 to 60,000. So we've had massive productivity growth. The other thing is innovation. It's remarkable when you look at this. 9 of the 10 most valuable companies today in the S&P did not exist in 1972. It didn't even exist. So that's a big driver of the fact that the S&P is not stagnant. You know, new companies are on there all the time, and that's part of investing. Then we look at another component, and we talk about dividends. So dividends, which is cash flow generated by these companies and cash flow paid out to their investors, have grown far ahead of inflation. One of the big believers of, you know, why we like stocks for the long run is that if you look at, you know, investing in cash, which is good for safe investments as well as parking money, but as a long-term investment, why stocks historically have provided to be a really good place to be, is that the cash dividends over the last 50 years have increased 21 times. And the consumer price index, which is a common use of as an inflationary index, is up 7 times. So the dividend that's being paid by these is substantially higher than what the CPI has been over that period of time. So a little bit of this, I know this is rhetorical because I don't have a live audience, but since the end of World War II, with dividends reinvested, what is the longest time to break even? And so why am I asking that question? Well, the biggest fear for an investor is I invest today, the markets lose money. How long will it take me to get back? And that's the really the fearful part of investing is you have a period of a big loss and how do I get back to break even? So the longest period of time over the last 50 years is the break even was 5 years and 8 months, which was August of 2000 to April 26th. A really long period of time. And remember, this was just in the S&P. So if you were more diversified in other areas like smaller investments using cash and bonds, the break even did happen a lot quicker. So the other thing in putting this together that this really resonated with me, this concept is that, and this is really hard, I think, for the average investor to put their arms around but it's important to remember when stocks decline that price and value move in opposite directions, right? So if you think about value is really defined as, is this a good price? And a good price to buy something at would mean if I buy something at this price, will I get a good return? So we're going to determine, is this good value? Well, the reason why price and value move in opposite direction is that if the price of the stock market goes down, presumably value is higher, right? Because you're buying something at a cheaper price. And conversely, when price goes up, things get more expensive. So then value theoretically goes down. And so that's one of the things to really remember is we get scared about price declines, but that means there's better value in the market. And we love when our portfolios are higher. We love looking at the 401k when values are higher. We feel better, right? But at that point, because prices have really gone up and the portfolio has gone up, value is actually gone down. So meaning things are more overvalued. The stock exchange is the only place where when they have a big sale, everyone runs out of the store, right? So it is counterintuitive, right? When you think about typical shopping habits, if you're going to go buy something and it goes on sale, you get excited about that. But when the stock market goes on sale, guess what? People aren't interested because there's a lot of fear out there and people are concerned that it can go lower. This is Charlie Munger, which is Warren Buffett's longtime partner at Berkshire Hathaway. If you're going to be in this game for the long pull, which is the way to do it, you better be able to handle a 50% decline without fussing too much about it. Now, I know that's a big ask for most people. Again, that's why diversification comes in. But if we do know long-term in equity markets, we can have periods of massive declines exhibited by just the three great bear markets that we have already shown you over the last 50 years. All right, so some key takeaways as we go through in our conversation today. So these are just really important things to remember. And some of you might look at this and say, oh, I'm not invested in individual stocks. But when we buy ETFs, mutual funds, those investment vehicles, whether it's in your 401k and your IRA and your brokerage account, those are all making investments in these fine American companies and fine overseas companies. But the shares of even America's finest companies have experienced frequent declines in price. That's happened, right? We know that. Some of these declines, driven by very real crisis, have been quite significant, which we know. Despite these setbacks, leading U.S. companies have continued to grow their earnings and dividends strongly over time. And finally, their shares have overcome even the deepest declines more rapidly than one might expect and gone on to new heights, right? So that's the whole idea. We get these corrections, but markets tend to recover and move higher. But again, we have to remember, past performance is no guarantee of future results. So one of the things, and what's nice, I think, going through, one of the things we have noticed about our clients and hopefully some of the education that we're providing through our webinars and just clients now having, working with us for, in some cases, a few decades, that there hasn't been much panic at all. Like I will get, my mom, when I do chat with her, she'll say, oh, your clients must be calling you nervous about what's going on. And so, yeah, they're nervous, but we've prepared them for these things. We know they're going to happen. It's not a question of if they're going to happen, it's more when. And so when we take that approach and we just acknowledge that this is part of being an investor, these are the big questions we have to ask ourselves is, this time it's different. So you're truly convinced that it's different, it's never been the same, and it's not going to get better, or this too shall pass. And I didn't put together a history of the, Time magazine headlines or covers, I should say. But if you look back at cover stories from the 70s and 80s and 90s, all the way up till now, it's pretty remarkable how they tend to repeat themselves with some of the scary and dire situations. And, we're going to have some challenges ahead of us. I do believe over the next 6 to 18 months, as we work through, the rising of interest rates, working through some of the excesses that we had post-COVID, there's going to be some challenges there, and exactly what they look like, nobody knows. Again, that's why we come back to why diversification is so important, to protect and to manage your money in a diversified manner. So we do believe this too shall pass. I'm really happy to report on a year where markets are positive. So we're not looking at this as we're looking at a year where we have losses. But we still haven't gotten back to, so we had losses in 2022, 2023, there are gains, but we haven't gotten back to the all-time highs in the markets. And we're going to probably, be a little bit choppy over the period of time. But, again, nobody has a crystal ball, nobody knows. And so the main way we approach this is, number one, we understand your financial goals, allocate your money given your financial needs. Make sure we assess your risk tolerance appropriately, because in periods of volatility, if we don't do that, then it might cause extraordinary emotions, which cause us to not be a long-term investor. So those are the two really big things that we do, and make sure we have discipline around that. And that's what we're doing every day, looking out for our clients. You've seen this quote before. So Nick Murray is a really well-known person in our business, in the financial services area, especially financial advisors. But I just love this quote, because I think too often investors will get caught up in, I'm worried about which way the markets can move. Is it going to go up 20% or down 20%? And his quote, and I don't want to fully butcher it, so I'll just read it. I don't worry about which way the next 20% move in the market will be, because I know exactly which way the next 100% move will be, and I can't run the risk of missing that move. And so it's a really clear point around, again, being a longer term investor and knowing that this too shall pass. So hopefully that, we ran pretty lean for our conversation today. I know normally we take a little bit more time, but hopefully this was short and sweet and to the point and provided some historical context. Just know that, at Vance Wealth, we're here to help you. We truly do feel that when emotions run high and there's challenges out there, that's when you need to lean on us the most. And so if you're feeling any of these things and you want to talk to your advisor, please reach out. I know we've been doing annual year-end reviews for most of our clients. So, if there are things that we're not, if there's guidance that you need from us, even just holding your hand, just know we're here, because that's our job, is to help. I mentioned early on that we have our annual market and economic update on Tuesday, January 16th at 4:30. So please mark your calendar. That's always my favorite one to do, because it's a way to recap what happened last year and start talking about the future of what our expectations are. Next year is an election year, so we'll also have probably some really interesting topics around the election cycle that we're going to go through. So if any of you are a prospective client and you would like to have a personalized consultation with one of our advisors, go ahead and scan the QR code, and reach out to us.